My name's Andrew and you're watching Don't Be a Statistic. 4 to 5 Canadians are financially illiterate and we're trying to change that. So today we're talking about what it takes to qualify for a mortgage with an A lender. A lot of these things are also applicable to any other loan, so keep that in mind. But there are 3 big things that determine an approval, and that's income, credit, and liabilities. So let's go. Dive in. Income. We're going to be talking about people that aren't self-employed first. So generally what we would do is you'd take your last 2 years T4s and average your income, and that's what we would take for qualifying. But if you happen to make salary or have a guaranteed number of hours, we wouldn't take your last 2 years average. You wouldn't need to have been on your job for the last 2 years. We would just take your salary or your guaranteed yearly income and use that for qualifying purposes. If you're self-employed, however, every A lender is going to want to see the 2-year history, and that's right across the board. The only way we could really get around that is if you had like an incredible first 20 months, first 22 months, and we would take your year to date and kind of fill in the last 4 months of that 2 years. But that would only be on an exception basis. We would have to go to the lender and get an exception on that. So generally speaking, you want to have that 2-year history right across the board. Credit. Credit is a little more complicated because it depends on what you're doing. Are you purchasing, are you refinancing, are you switching, and what lender it's with. Every lender kind of has different credit requirements, but right across the board, the lowest credit score you can have with an A lender is 600. That's the bottom of the line. But generally, A lenders want to see at least a 640 score. So honestly, just try and keep your score above 680 because then it'll benefit you all the way across the board and you won't have any problems. And I've already told you guys how to build your credit as quickly as possible. Liabilities. I've said in a couple other videos that I have to keep your liabilities within a very specific percentage of your monthly income. That percentage I refer to as ratios. We've got 2 ratios we work with, the GDS and the TDS ratio. The GDS refers to all cost housing. So that would be your qualifying mortgage payment, property taxes, heat, condo fees, strata fees, all of those things would fall under GDS. TDS refers to everything else plus the GDS. So the TDS is made up from the GDS plus everything else, like credit card payments, car loans, personal lines of credit, personal loans, all of those things would be added onto the GDS to create the TDS. And we have to keep your TDS under 44% of your monthly income, and the GDS has to be, depending on your credit score, either under 39 or 36% of your monthly income. And that's dependent on whether you have above a 680 score or below. So I said just keep your score above 680 and you'll be laughing. Here's something that's going to change how you think about your car payment. Every $400 a month in liabilities reduces your buying power by about $100,000. So if you have an $800 a month car payment, you can afford $200,000 less when you're looking to qualify for a house. Thanks for watching this video. I'll catch you in the next one. Remember to tell everyone everything you learned because that's how we change the statistic. Thanks.